Hello everyone, my name is James Perry and I'm a lecturer for ACCA Belfast, and in this session we'll be looking at F8, an introduction to assurance. So what is assurance? Assurance is expressing a conclusion on information which is normally financial in nature. An example of that will be a set of financial statements. Assurance actually gives an enhanced degree of confidence to a number of stakeholders, whether that be management, shareholders, potential investors, or the bank, or even the Inland Revenue. And assurance is an evaluation then of subject matter against predetermined criteria. And what do I mean by that? An example could be that of a retail business, which would manage stock levels based on a stock turnover ratio. An experienced auditor who is experienced within this type of retail industry may have an expectation of what that stock turnover level may be, and may be able then to measure actual stock turnover against that benchmark and investigate any unusual trends or variances within that. This technique is called an analytical technique. So there are 5 elements within an assurance engagement. Number 1 is the parties involved. That would be the audit firm and the client, and the relationship is drawn up or described in what's called the letter of engagement. The second element then is the subject matter, which again will be clarified within the engagement letter, i.e. what are we actually going to be auditing. Third point, as previously mentioned, we need a suitable criteria to evaluate against. Another example of this could be where we audit this year's financial statements and look at last year's financial statements as a benchmark to evaluate against. The fourth issue is sufficient evidence, and this is key to an assurance engagement. As an auditor, we must have sufficient appropriate audit evidence to substantiate our audit opinion. And then the audit opinion itself is contained within the assurance report. I'm going to talk about that a wee bit more in the next slide. So there are 2 types of assurance engagement. Number 1 is a reasonable assurance engagement, and this is where the audit practitioner will gather sufficient appropriate audit evidence. And in doing that, they will do enough work to be able to draw reasonable but not absolute conclusions. And this is done with the concept of materiality in mind against identifiable suitable criteria. The reason why there is not absolute conditions is the fact that no set of financial statements, for example, are correct or accurate. That is why an auditor will give the opinion of a true and fair view. And in this statement of true and fair view, that's an example of a positive statement of opinion. And that is normally contained in an example being a statutory audit report. The other type of assurance engagement is that of a limited assurance engagement, and that is not as strong as a reasonable engagement. So within the limited assurance engagement, the practitioner will gather sufficient evidence to assure that or be satisfied that the subject matter is plausible in the circumstances, not necessarily reasonable but plausible, so it's not as necessarily as strong. And in his audit report, it will be a negative statement of opinion, i.e. that nothing has come to our attention. Again, not as strong, it doesn't actually come out with a positive statement. However, examples of a limited assurance engagement will be an audit review, a risk assessment, or perhaps looking at IT within a business, or even looking at things, for example, such as key performance indicators within the business. An issue to look at is the expectations gap, and this is the gap between the public or stakeholders' perception of what an auditor does, what the auditor actually does in reality. Examples of that could be that the public may believe that the auditor is there solely to detect fraud, and that isn't the case in reality. Also, stakeholders may believe that it's the auditor's set of accounts, but actually the set of accounts belong to management and shareholders. There's also a belief that auditors should be able to predict business failures as well, but again, that's not the case. It is only if indications are given within the auditor's normal course of business that they may report such findings to management. So thank you for your attention. Hopefully that was of benefit and giving you a brief Introduction to Assurance. So all the best for your studies. Thanks again.